Good afternoon once again. Good afternoon, class.
Good afternoon, sir.
Okay, I think it's time. We can't wait anymore. We have to start doing something. So we start whilst we wait for our friends to join us. This lecture is supposed to be our last lecture. And it's on the topic called relevant costing. Very beautiful topic. It's one of the topics that is going to provide us with some useful decision-making tools in life, and most importantly, in our business lives. Relevant costing. Actually, this is what the whole thing is about. The focus of the whole of the topic of management accounting is on decision making, if you remember. And this particular topic is going to actually point everything to decision making. When we have to make decisions, when there is a decision to be made, what are the relevance of those decisions? When we're able to sift out the relevant issues for any particular decision we want to make, then we can be sure that our decision is going to be right. But if we don't know the relevance, the relevant issues pertaining to any decision we want to make, then we can make decisions that we might think is right, but in fact, it is totally wrong. That is why this topic is very, very important. Even though the topic is actually made for business environment, it is also applicable to almost everything we do in life, in our personal lives as well. All right, so that's what we're going to do. The topic on relevant costing starts from, I think it's, yes, it starts from page 263 of your textbook, and which is also chapter 19 of your textbook. Right, I'm telling you this because after the lecture, you have to go and read the text. And if possible, you can even lay the text side by side with you going over the lecture in terms of watching the video. The video is being recorded as we are speaking. After the lecture, I will upload the video on your YouTube channel. Make sure you have subscribed to the channel so that not only this video, any subsequent tutorials. I told you that after this lecture, and that is going to be the end of the semester as far as this course is concerned. But we will still be engaging ourselves in terms of tutorial and providing you with some supplementary information as I see necessary to guide your learning for the exam. So you do yourself a huge damage not to subscribe to the channel. Subscribing to the channel takes nothing from you. So I don't know why you will choose not to do that. So let's all try to do the right thing to help us pass the exam. So relevant costing, that's what it is. Let me give you let me just give the overview. I've just talked about the fact that we do a lot of decision making in business, and for every decision that we have to make, we should have the tools to guide us to know that this issue is relevant to this decision. This issue is not relevant, so that we can get a decision making right. That's what we're going to do. And most particularly, we are going to concern ourselves with relevant costs. Relevant costs and relevant revenues. So for every decision that we want to make, what are the relevant costs? What are the costs that pertain to the decision? Not some other costs which has no relation to the decision. If you bring in such costs that are not pertaining to the decision making, then you are kind of blurring the whole of the decision making exercise, and the decision is most likely to go wrong. So how do we know that these are clearly the relevant costs associated with this decision? How do we know clearly that these are the relevant revenues associated with this decision, so that we can come to the right conclusion that it makes profits, it makes business sense for us to go into this decision or otherwise? So much of the discussion will be centered on relevant costs, relevant revenues, right? So let's go through the things we'll be doing. But before that, let me just ask a small question. Let's brainstorm on something. I'm just going to say something. Pay attention to it. I'm going to ask you whether it makes sense to say that or it doesn't make sense. And this is what I'm saying. Let's try to take decision for what we did yesterday. Let me repeat what I said. Let's try to decide, take decision for what we did yesterday. So analyze that statement.
Okay, sure.
Analyze that statement. You heard a statement, right? What do you have to say about that statement? What do you have to say about the statement I just made? Hello? I'm waiting for your response. Serafina. Serafina Janku. Is Serafina in class? Janet Smart, respond to the statement I made. What do you have to say about it, Janet?
Please, my network was fluctuating, so I couldn't hear what you said.
Okay, let me repeat the issue. I said I'm making a statement. Just listen to the statement and express your opinion on whether the statement, it makes sense to make that statement or it doesn't make sense. And this is the statement. Let's decide on, or let's take decision on what we did yesterday. That's the statement. It's completed now. You can comment on it.
You said what we did yesterday.
Yes.
So yesterday, I'm gonna join the class. Like, is it a statement or?
I'm not asking you a question. I made a statement. Make yours, say something about whether that statement, what that statement means to you, whether it makes sense to say that or not. It's a general statement. It's not a statement to you per se.
No, it doesn't make sense.
Let's understand why it doesn't make sense.
So because it isn't complete.
It is complete. Okay, so this is what doesn't make sense about it. Let me repeat the statement and I'll highlight why it doesn't make sense to say that. Let's decide or let's take decision on what we did yesterday. This is what I wanted you to spot to be the flaw in that statement. We don't really make decisions for the past. Past is past. We make decisions for future. So you cannot say you are planning for yesterday. You can only plan for tomorrow. You cannot plan for the past. All right. So I just introduce the whole topic with that because that is going to be the main framing of your thinking around relevant costing. But let's jump to some principles of before going to the principles of identifying relevant costs. Let's first of all try to understand what relevant cost is or what a relevant benefit is to a decision. And please always try to understand it in this way. It is relevant costs or benefits arising from a particular decision. Relevant cost or benefit to a particular decision. And I just told you that we make decisions only for the future. It is not correct to say you are deciding for the past. In fact, it is not possible. You can't do that. So you have to guide your thinking with these things. As we are moving forward, I'll be asking you certain things based on your past knowledge. But you also have to get the understanding that we make decisions for future, not past. And we are talking about relevant costs and benefits arising from a particular decision to be made in the future. All right. So a relevant cost or benefit is a future cost. For the cost to be relevant to the decision making, first of all, it must be a future cost because we can't decide for the past. The decision cannot be for the past, it can only be for a future. It must also be an incremental cost. What do we mean by incremental costs? Incremental cost, that is the increase in cost as a result of taking the decision. Is the cost such that without taking the decision, there will be no such cost? Is the cost such that with taking of the decision, such cost came into existence? Then that makes it an incremental cost arising from that particular decision, and therefore a cost which is relevant to that decision. If we take the decision and the cost is the same as not taking the decision, then there is no increase in the cost. There's no incremental cost. If there is an additional cost, and that cost is exclusively coming into being as a result of the decision we are taking, then that is an incremental cost. It must, relevant cost also must be a differential cost. It must be a differential cost. Even though I'm using cost, the same thing applies to benefit. Relevant cost or benefit must be a differential cost or differential benefit. What do we mean by differential cost or benefit? It is the difference in cost between two decisions. For example, we'll talk about it very soon. For example, we want to take a decision of whether we want to produce a product by ourselves, that is, produce the product in-house, or outsource the production of the product to an outside organization. In other words, we are deciding between doing a product ourselves or buying it from someone who has already made it. In analyzing the relevant costs and benefits to such a decision, the decision is two things, this way or that way. Then what is relevant for the decision to do it this way or that way should be the difference in cost between them, and that is differential cost. When we take examples, it will highlight these definitions we are trying to put across. Relevant cost must be a cash flow. And what is a cash flow? I've defined cash flow in class before. That's why I'm asking you. I want you to kind of remind yourself of what we said about cash flow. Say something. What is a cash flow? All the people I have in the class now are almost all females. What are the guys doing? You're watching football, right? And betting.
No, sir.
Okay, Francis, you are the only gentleman. Yourself and a few other people.
Yeah.
Ivan Sata and Alfred Doe.
Yes, yes.
Yeah, so Francis, say something up on what a cash flow is. What is a cash flow? Francis, cash flow.
Please, cash flow is a cash flow. Means the movement of cash within the cash that comes within the organization and that moves out of the organization.
Okay, so give us an example. Because the definition per se may still not make people understand. We need to understand it practically. So give an example or examples.
The example of cash flow is the payment of rent as
Okay,
an
good.
expense or something.
Okay, so Francis, help us again to understand what cash flow is not. And then you can also kind of make us understand it better by giving us example about non-cash flows, some examples of non-cash flows. What is not a cash flow?
Okay,
For
so what
example,
is not a cash flow? They are realized, but we've not actually made payment or received anything from that.
okay, good. Example.
So, example is depreciation.
Exactly. So you are right. I want to believe that everybody, because I said this in class and you are just telling me what I said, which is good. Means you. Who is that? So I want to believe that everybody has that understanding, which is very important because relevant costing is about cash flows. And if you don't understand what a cash flow is, that's a fundamental problem. It will be very difficult for you to build your understanding for this particular topic. Cash flow, that's what Francis helped us to know. So we've said all the attributes of a relevant cost or benefit. It must be a future cost or benefit, incremental cost or benefit, differential cost or benefit, cash flow. Cash flow, explicit receipt of money, which is revenue in this case, or benefit in this case, and explicit payment of cash. No implicit. No notional cost or benefits. And he gave an example like depreciation. Depreciation charge against the profit. Go and bring the receipt. Which person did you pay that money to? It is not an explicit expenditure. It's a paperwork. So you have to understand what cash flow is, what cash flow is not, because relevant costing as we are doing has a lot to do with that. So this whole idea of relevant costing, I've given the overview from the beginning. But let's through this slide talk about in which areas in business, which areas in general life that we have to employ, that we need to remember that, wow, this is the time for us to think relevant costing. This is the time to pull that kind of tool from our toolkit and employ it for our benefit. Okay, so that's what you see on the screen. There are two basic types of decisions where relevant costs are used. One, decisions about whether to do something or not to do it. Of course, you have to understand, we are doing cost and management accounting, so the focus is more on costs and benefit as opposed to some other strategic issues. We'll talk about some of those other strategic issues, but the main decision criteria is on costs and profits in totality. So the first type of decision where relevant costing may be the necessary tool to employ. So you are taking a decision about whether to do something or not. Can someone give us some decision like that he has taken before or he is about to take, to do something or not to do something? Class, I need your participation. Dorothy. Dorothy. Dorothy.
Hello. Please, the question again.
Hey, so when I'm speaking, it means you guys don't pay attention.
Please, I was, but
Okay, I said we're talking about decisions where we need relevant costing as a tool to help us to do right decision making. And one area of decision where we need relevant costing is where you are deciding whether to do something or not to do something. And we have examples of such decisions in our lives. Things we have done before or things we are about to do. We want some personal example from yourself. To do something or not to do something. Anything that you are contemplating on whether to do it or not to do it. Give us an example.
okay. Okay, so I sell erasable pens. For some time now, I wasn't getting some. So I just saw someone, the person also selling some. And I also have people that they buy in bulk from me. So they told me they wanted some parts. But the money that I was having on me, I was going to use it for something else. So I was just thinking about it, whether to use the money to buy the pens, and then later on I do what I wanted to do with the money later, or what. Okay, so I hope it's okay.
Okay, so I have heard you, but I want you to do some summary
Okay.
about what the two things that you are thinking about. I mean, no, it's
I'm
one thing.
thinking,
That one thing that you want to do or stop doing.
okay. I'm thinking whether to use the money to buy the pens or to use the money to do the one thing I wanted to do initially.
Okay, that's good.
All right.
Okay. Dorothy's Dorothy's illustration fits the second type of decisions where we employ relevant costing. Decisions that involve selecting between two or more different options about what to do. Now, Dorothy is contemplating whether to use the money to buy the pens or to use the same money going into some other venture. That is the second type of decisions. And we do most of these things every day in life. Every day in life. All right. The first one, whether to do something or not to do something. An example is whether you have to come to the university or not to come to the university. Of course, it will almost always result into a decision like the second type. Because if you do decide that you want to come to the university, you are going to sacrifice something that you could have done in place of coming to university, which is choosing between two things. So it is basically a tool for analyzing decisions of selecting between alternatives, two or more alternatives. Right. So let's go ahead. So these are the areas of decisions that we normally need the tools on relevant costing. Other variants of the same two types. The two types we talked about, some derivatives of the two types can be these things. Deciding whether to agree to accept a job or undertake some work at a stated price that the customer will pay. Let me explain that further. In business, sometimes you have your main business you do. Then along the line, you get some contract. For example, those who are into production of pastries and decoration and those kind of things, they might have their main business line. Maybe they have a big shop that they produce the pastries and they sell from that point. It is a normal thing as part of their business that some events manager may see them and say, okay, this event is going to happen. We need you to produce this. That's a contract, some one-off job, some one-off contract. And sometimes those people come where they are cost constrained, so they come and negotiate for a price that they can pay. That price could be different from your usual prices. Do you have to accept to do that job or not? 2, whether to sell joint products from a common process at a point where they are output from the common process. I'll explain further. Or whether they should be processed further before selling them at a higher price. And this normally happens at the processing businesses. For example, those who extract, let's say, oil. When they are doing the drilling at the primary stage, is a huge liquid, mass of liquid in one pool. And then at a certain point in time, you get extraction of maybe petrol, diesel, kerosene, bitumen. So at the split off point, at the point where you can say that this is petrol, this is kerosene, this is bitumen, and so on and so forth, do we just sell the outputs as we have identified them, as we have extracted them, or we should process, for example, kerosene into some higher level product before we sell? We should process petrol into some other higher level of product before we sell. That is about further processing decisions. 3, whether to make a product in-house or to subcontract or outsource the work to an external supplier. Right. So these are the key specific decision areas that involve the application of relevant costing. And let me say this before I forget. This topic is not difficult, but it is actually not a topic for people who go by chewing. You can never understand it if you're the chewing type of student. You can never understand it if you are the rote learner, chew and pour type of student. You need to be involved. You need to understand it. You need to understand the principles. If you go by that way, you will always understand what the question is and you can solve it to a very good extent. Okay, so with that said, now let's look at principles guiding the identification of relevant costs and benefits. Okay, so we have this scenario about a decision to take. Do we have some principles that we can follow to identify, okay, this is relevant, this is it. We have already talked about some of them, like incremental costs, future costs, differential costs. They are all part of the principles. But let's see some other things, or let's repeat it for emphasis. Principles guiding identification of relevant costs and benefits. Relevant costs or benefits must be a cost that will be incurred in the future. That will be incurred in the future. Which means that any cost that has already been incurred outside of the decision, they are costs that we have incurred already. They were not incurred because of the decision that we are about to take. Any such cost is not relevant to the decision we are about to take. Past costs are sunk costs. That's how the economists call it. And they are not relevant costs. Relevant cost or benefit must be a cost or benefit that results in cash flow. And we have already reminded ourselves of what a cash flow is and what is not a cash flow. So you need to have the understanding that some notional costs, some implicit costs, like depreciation, is not a relevant cost. Relevant cost or benefit must arise as a direct consequence of the decision. It must emanate from the decision making. It must be a cause which was driven because of the decision. Any cause which would have incurred anyway, whether the decision is made or not, is not relevant to that particular decision. Any costs or benefits that will happen anyway, regardless of the decision, cannot be relevant cost to that decision. Which means that, as I said earlier, sunk cost, which is a past cost, that cannot be a cost that we incur because of a decision we want to take. That is not a relevant cost. Committed costs. Even though committed costs will still be future costs, what is creating that commitment is a past decision. For example, if we hired some equipment for work, for some other work, maybe for our general work, and hiring, you have to pay the charges sometimes into the future. We pay some this time, we pay some other time, and so on and so forth. So we have the high charges, high purchase charges. Some to be paid next month, next 2 months, next 3 months. They are future costs. So by definition, that cost meets some aspect of relevant cash flow. Sorry, relevant cost, because it's a future cost. But is it complete? Is it relevant to a future decision? The decision, the cost, even though it is yet to be paid in the future, that cost came into existence as a result of some past unrelated decision. So if you hire the equipment for our general work, and now there is some contract a customer wants to give us, we can use that equipment, I mean, partly for that contract that the customer is giving us. But can we charge the costs of that equipment to the decision to do the contract for the customer? No, because we had already bought that equipment. If we decide not to take the customer's contract, we will still pay for the high purchase of those equipment, because we hired those equipment not specifically for the customer's contract. It is something that we generally use and which we have to pay anyway. That's committed cost. And that is how it is not a relevant cost. Okay, so at this point in time, let's pause a little bit and ask whether someone has something to comment about, something to ask. Any questions, any issues? Before we progress. If you have anything, please let me know before we move on. Okay, so silence means everything is cool. So we are now going to go into some specific areas. Relevant cost of machinery. When we decide to accept any contract, in other words, any future decision we want to make, especially in business, may require the use of some machinery, which means we have to have a look at this to help us do a good decision making. Relevant cost of machinery. If we accept a job, or if you're contemplating accepting a job, of course, because it is a decision to be made, it will always be a contemplation first. We are contemplating, we are appraising, we are doing assessment prior to acceptance, so that we can know whether to even accept or not. And the decision or whatever contract that we will be doing will require the use of machinery. How do we know that this part of machinery cost is relevant to the decision and this part is not relevant to the decision? Generally speaking, machinery that we have purchased already, and sometimes this is why it happens so. We are already a business concern. We do our job already. And it is normal that some contracts can creep in, can come in from time to time. So we always have to decide whether it makes business sense to maybe sacrifice some resources of ours to do that wayside contract, or we should forget about it and focus on our mainstream business. So we would already have some machinery for our usual work. And now there's an offer from a customer to do some special job, some special work, which will require the use of machinery. And we want to know the costs of that special job. So the part of the cost of the special job that is coming from machinery, how do we get to know it? Those machineries that we have purchased for our normal work, not for the special contract, the cost of them are sunk costs, and we cannot charge it to the contract we are yet to take. We already know that depreciation cost is not a cash flow and therefore not a relevant cost. However, if using an existing machinery, even though we have bought it already and the cost is not relevant. If using the machinery for the special job or contract will cause that machine to lose some value, and we can determine that loss in value, then that loss in value is a cost that we need to charge to the contract because the contract caused that loss in value. They call those costs, normally they call it user costs. The cost coming as a result of using. So that cost pertains exclusively to using the machine. And the user cost that comes from using the machinery for the contract should be charged to the contract. That's a common sense. Also, if the contract will require its own special machinery, then that one is obvious. Buying that machine is exclusively because we are going to do that contract, and therefore the costs and any other costs about that special machinery should be charged to the contract because that machinery is exclusively, the cost of that machinery is incurred as a direct consequence of undertaking the special contract. Opportunity cost is also a relevant cost. Where using a machinery for the opportunity in question, for the contract in question, requires the sacrifice of the next best alternative, the resulting opportunity cost is a relevant cost to consider. The resulting opportunity cost is a cost that needs to be charged to the special contract. So these are the key issues about relevant costing of machinery. All right. Let's see some example. Okay, I don't have them in this sheet. It's still on the PowerPoint, just that it's very small, so I wanted to show it in a different sheet. But you can follow up this question from your textbook. It's in your textbook. So let's take this simple question. I will try to see which cost of machine is a relevant cost to this particular contract and which is not. So let's all get involved, be interested, follow with the question so you can make comments. Bronte Company is considering whether to undertake some contract work for a customer. And that is what makes it a future decision. It's considering whether to undertake some contract work for a customer. The machinery required for the contract would be as follows. A special cutting machine will have to be hired for 3 months for the work. And the 3 months it coincides with the length of the contract. You have to hire it. Hire charges for this machine are 75 Ghana cedis for a month, with a minimum hire charge of 300. B. All other machinery required in the production for the contract has already been purchased by the organization on hire purchase terms. The monthly hire purchase payment for this machinery are 500 Ghana cedis. This consists of 450 Ghana cedis for capital repayment and 50 cedis as an interest charge. The last hire purchase payment is to be made in 2 months' time. The cash price of this machinery was 9,000 2 years ago. It is being depreciated on a straight line basis at the rate of 200 per month. However, it still has a useful life which will enable it to be operated for another 36 months. The machinery is highly specialized and is unlikely to be required for other more profitable jobs over the period during which the contract work will be carried out. Although there is no immediate market for selling this machine, it is expected that a customer might be found in the future. It is further estimated that the machine will lose 200 cedis in its eventual sale value if it is used for the contract. So let's make it, what are the relevant costs of machinery in connection to this contract? Are you with me? Hello?
Yes.
Yes, sir, we are here.
Okay, so let's use about 2 minutes to go through the question ourselves, and then we will come to answer the requirement at the bottom. What is the relevant cost, or what are the relevant costs of machinery to this contract? I'm just giving 2 minutes. Okay, are we done? Are we done? Hello?
Yes, sir.
No, sir.
Yes, sir. No, sir. Which is which? Okay, so we should be done. The question is, what are the relevant costs of machinery for the contract? You can pick an item of cost that you think is a relevant cost or not a relevant cost. Explain, just tell us the item of cost. Explain to us how it is a relevant cost or how it is not a relevant cost. Let's pick them one after the other in that session, and then we'll put all of them together and have a summary costing for the job in terms of machinery cost. Who wants to talk first? Emmanuel Frimpong. Emmanuel Frimpong. 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 Frimpong, talk. We are listening to you. Frimpong is not talking. Promise. Promise Inu.
So, some of us just joined the class, so yeah, we are finding it difficult to get the concept about
Okay.
the question.
No problem. Kingsley. Kingsley Kusi.
Sir, hello.
Yes, sir. Go ahead.
Uh, uh, Sir, the relevant cost, when you were explaining, I wasn't in the meeting, so I just joined.
Okay, no problem. So if you take this particular question, we said we gave ourselves a framework through which we can ascertain relevant costs and benefits. We have looked at the specific principles when it comes to ascertaining relevant costs to machinery. So we're going to use the same framework. They are in your textbook. You can read them after here. The machine that is bought exclusively because of the contract, which means the cost of such a machine emanates from, or it is incurred as a direct consequence of undertaking that project, accepting that contract. That's one of the principles we said. And you can see that a special cutting machine will have to be hired for 3 months. Will have to be hired, though. Will have to be hired because we are going to undertake that project. If we decide not to accept the contract, we will not hire this. So all hire charges that is coming with this machine is coming as a direct consequence of deciding to undertake the contract. So you have to itemize that this is a relevant cost to accepting that contract. Now let's look at the figures involved. The length of the contract will be 3 months. The monthly hire charge is 75, all right? So the total cost will be 75 times 3. That will be what?
So
Sir,
225.
225.
Good, 225. But look at what continues. With a minimum hire charge of 300. So what is happening here is similar to how rents charges are done in our country. You know, rent for a room, the charge is in months, right? It's calibrated in months. So they will tell you, oh, what is the cost per month? That's normally how they do the costing. Maybe 250 a month, maybe 1 bed, 2 bedrooms, blah, 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 250 a month, 350 a month, 300 a month, for example. Okay. So if that is what it is, then it should have been possible that I can go to a landlord and tell the landlord that, please, I want your room, 3 bedrooms, 1 big hall, and the rest. The cost of which is 300 Ghana cedis a month. Then I can tell the landlord, please take 300 Ghana cedis. Let me go in. So I'll be paying month by month. But is that acceptable as a practice? I'm asking, it's a question. Hello? Hello? Do you understand the question I asked?
Sir,
No,
can you
sir.
please ask again?
I said, the issue we are dealing with here is just like the way rent charges happen in this country. The rent for the apartment is in months. So if it is 2 bedrooms, one big hall plus kitchen and other things. In Cape Coast here, that will be around, it depends anyway, but the average will be about 300 cedis a month. And I'm asking, if that is how we do the costing for renting, can I go to the landlord and say, landlord, I have my 300 cedis for a month, take it, and let me go in to occupy the room. Is that possible? Still don't get a question?
Yes, please.
You still don't get a
So you
question?
said, yeah, you're having 300 cities for the rent.
So it won't be possible.
I don't know what is actually wrong with you. I make simple statements and you still tell me you don't understand or you didn't hear it. Who heard it? Just answer the question. I don't have time for that kind of business you sit there and do. Who heard it? If you heard it, just answer the question for me and let's make progress.
Please, the landlord or landlady will take for like a year. Won't take the month's 300.
Good. That is good. So even though the room is costed on monthly basis, 300 a month, no person will take the 300. Some of them will not even take a year. Some of them will want to take advance payment. They will tell you, okay, I'm taking a minimum of this amount. And that amount, regardless of the number of months in it, that's the minimum they will take. Similar thing is happening here. Even though the charge per month is 75, the guy who owns the machine says he will take a minimum high charge of 300. And you see the 300 will go a little above, the 300 will be how many months? 1 month is 75. Divide 300 by 75. Let's see the number of 4 months. Good.
Yeah.
The 300 will be 4 months. But this is the minimum he's taking. He doesn't care. If you can save for the 4 months, fine. If you are in for 3 months, then the remaining month is your own cost. So that's what is happening. So this is the cost that a guy will take, the 300. So when we are costing the contract, in terms of the special cutting machine, this is the cost that we have to allocate to the special contract, 300. And you have to understand why it is 300 and not the 75 because of how I have explained it. B, it says all other machinery that the special contract can use, they have already been purchased. It's already in the organization. That machine that is already in the organization, the cost is 900 Ghana cedis. The cost is, 9,000 Ghana cedis. Someone should say something about this cost. 9,000 Ghana cedis. That's the cost of another machine which is already existing in the organization. Talk about this cost in terms of whether it is relevant or not relevant and why. Patience, Fianco. Patience. 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 Hannah Baffo. Hannah. Hannah. Okay, Kingsley, you can talk about it. Kingsley.
Sir, please, the 9,000, it was the price for the old machine. And when we are talking about the relevant cost, is the cost that are incurred in the future. But the 9,000 was incurred in like producing the last machine the company was using.
Okay, so that is incurred in the past.
Yeah.
So the fact that it's incurred in the past is one way of noting that it is not a relevant cost.
Yes, please.
Additionally, that cost, the cost of those machinery, is not because of the special contract. They were already there. Just that the special contracts can make use of them. So it is not a cost that is being incurred as a direct consequence of the decision to accept the special offer or order or contract. And therefore, the 9,000 is not a relevant cost. Then they said that 9,000 machine, it was bought on high purchase or maybe lease, finance lease terms. So we pay them in installments. Every month we pay 500. The monthly hire purchase payment for this machine is 500 Ghana cedis. Is that 500 Ghana cedis relevant cost or not? Dorothy. Dorothy. Dorothy, bro.
That place I'm here, but the environment is so noisy.
Francis Obin. Francis Obin.
Yes, sir.
Francis, we need to hear from you on the question.
Okay, sir. I think the 500 is not relevant.
How or why?
Uh, so it says that the machine has been already been purchased,
Okay,
so it's not relevant.
good. So I want you to have remembered some terminology we came across when we were giving the introductory lecture. Committed cost. Committed cost is a future cost. It's a cost we are committed to paying. But a commitment is not as a result of the contract. It's as a result of some other past decision. And committed costs are not relevant costs. So the monthly high purchase costs, those ones we have paid already, that one is clear. Once they are even past costs, they are not relevant. But see this, it said that the last high purchase payment is to be made in 2 months' time. It's to be made in 2 months' time. And that will be 500. it will be made in 2 months' time. It's a future cost, but this is what we call committed cost. This 2 months' time, 500 high purchase payment we have to make. The obligation came into being as a result of some past decision. So we are committed to it anyway. It's not because we are choosing to accept the special offer. So it is not relevant cost to the special contract we are thinking of undertaking or not. Is it clear?
Yes, sir.
Okay. Now it is being depreciated on a straight line basis. The old equipment, whose cost is 9,000, is being depreciated on straight line basis, and the depreciation rate per month is 200 Ghana cedis. Is that value a relevant cost or not? Evans Atta Evans. Evans Atta has intentionally left. Emmanuel Frempong.
Sir, please, Emmanuel Frimpong's microphone is not working. Oh. That's
Oh,
why.
so he's with you. Let him speak through your device.
Okay, sir.
Frempong, answer the
Yeah,
question.
please, I'm using someone's laptop and the microphone is not working.
Okay, I mean, sorry about that. But you can be speaking through your
No,
friend's device.
no, he's at some place and I'm also at some place. So I'll just need to concentrate and I will
I can't hear
concentrate.
you, please. You are speaking to a whole crowd. Talk out.
He's at some place and I'm also at a different place. So I will just leave him to concentrate and I'll also concentrate on the lecture.
I don't get you. I want you to answer a question. So answer the question, please.
Please, which question?
So what have you been doing? It means you've not been following the lecture.
No, I was following, but the network, I'm at CAG and the network was just misbehaving. That's why.
Okay, this is the question. There's a question on machinery costs. We have a case about it, and we want to identify which cost item is a relevant cost and which is not. This is a piece of information. There is
Okay.
some machinery which are already existing in the organization, the cost of which is 9,000. This machinery is being depreciated on a straight line basis, and the depreciation rate per month is 200 Ghana cedis. This 200 Ghana cedis per month, is it a relevant cost to the decision to undertake the future contract or not? And explain your answer.
Okay.
Okay is your answer. Okay, so anybody can talk.
Sir,
Promise.
sir, when I went through the video that you did, it's not a relevant cost because it's not a cash flow.
Good. It's not a cash
Depreciation.
flow.
Say something.
Depreciation is simple.
Yes,
Depreciation is not a cash flow. You don't need to look at any other thing again. Just because it's not a cash flow, it's okay for you to exclude it. For you
okay,
to
sir.
see it as not a cash flow. Thank you very much. Then let's continue. The machinery is highly specialized and is unlikely to be required for other more profitable jobs over the period during which the contract work will take place. This piece of information, what is it telling us? The machinery is so highly specialized and it is not likely to be required for any more profitable jobs. That is telling us about opportunity cost, because opportunity cost is a relevant cost. But this framing tells us that this particular machine basically has no opportunity cost to it. You have to get these understanding because in some other question, the framing can mean that the machinery has an opportunity cost to it. And it is your job to identify the differences in the different scenarios. Okay, so that is why I told you you cannot chew this. This is not for those kind of students. If you try to chew this, you always fail. Okay, so there's no opportunity cost. Although there is no immediate market for selling this machine, it is expected that a customer might be found in the future. It is further estimated that the machinery will lose 200 Ghana cedis in its eventual sale value if it is used for the contract. Is this one a relevant cost or not? And explain your answer. Patience Fianco. Patience has logged in and she is staying somewhere else. Patience Fianco. Francis, go ahead.
Hello, sir. Please, I think it's a relevant cost.
Okay, so let us understand why.
The reason being that even though the machine will be sold out, it will lose a value of 200 before it will be sold, and that 200 has to be paid by it should be paid within the contract, as you explained earlier.
Okay. The part that I wanted you to nail it was that 200 loss in sale value is exclusively caused by the contract. See how it said it. 200 Ghana cedis will be lost. Let me start from the beginning. It is further estimated that the machine will lose 200 Ghana cedis in its eventual sale value if it is used for the contract work. If it
Yes,
is
sir.
not used, that loss in selling value of 200 cedis will not occur.
Yes.
So it is clear that the loss in 200 sale value will be caused by the contract. And if you caused it, we charge it to you. That's just common sense. Okay. So we have been able to identify all the relevant costs and those that are not relevant costs. So if you have to prepare a summary sheet for relevant cost of using the machinery that should be chargeable to this contract, this is how it may appear. Summary of relevant cost, incremental high cost. That is the special cutting machine, 300. The one that the guy was taking 75 cedis per month, but this is the minimum he will take. So this is the cost to the contract. User costs. That is the cost that comes about as using the machinery. It was said that when the machinery is used for the special contract, it will lose sale value of 200. That 200 should be charged to the contract. A total of 500 Ghana cedis of machine cost in this particular scenario is what should be chargeable to the contract. Any questions? Any questions? Quick one. No, sir. Okay, then let's go. We also have the understanding that in business, deciding to undertake some project, some job, some contract or not will require the use of labor. So let's look at specific principles, some general principles around relevant cost of labor, which will help us so that if you get a bigger scenario, we can bring all of these parts together and solve the question. Now let's look at relevant cost of labor. And this is how normally things break down when it comes to labor. The organization in question, which is contemplating whether to accept some special contract, may already be having labor, that is, working on their usual operations. Sometimes the organization may have a temporary idle capacity or spare capacity. This is what spare capacity means. For example, here in the University of Cape Coast, every lecturer is supposed to teach a minimum of 12 hours a week. They call it your teaching load. But it is true that some lecturers teach less than the 12 hours a week. So such lecturers have spare capacity. I just use that as an example. If you go to a manufacturing business, sometimes due to um, going down in demand, I mean, due to some downward trends in demand, we can have a situation where we have more workers than we need because we are producing less. Demand is going down. But we still maintain such, especially in the short term, we still maintain such employees. And you can find that a lot in public sector. In public sector here in Ghana, you can find a lot of idle labor. Even here in the University of Cape Coast, you can do a study on the idle labor in connection with cleaners. They are on government payroll and they are bound by all the rules, the working rules in the university. The working rules about time is that we start work from this time and end work at this time officially. And it's been, I think, maybe 8:30, if not 8 o'clock, to 4:30. But cleaners come in here, they just come and they don't even do any proper cleaning. They just lazily sweep around, and immediately after sweeping, they leave and go. They don't come again. So let's say they come in, let's say, and they are kind of creating this useless argument of coming early. No labor comes to work at 4 a.m. They don't even come at 5. So the earliest could be 6. So if you come in 6 o'clock and you finish your cleaning by 10, how many hours? 6 o'clock to 10 o'clock, how many hours? Hello?
4 hours.
4 hours.
Yes.
Then the official hours they should use to work, let's say 8:30 to 4:30. How many hours involved? 8:30 a.m. to 4:30 p.m. How many hours? How
At
many hours?
least 12.
12 hours.
Yeah.
Okay. So instead of working 12 hours, how many hours are they working? 4 hours.
4 hours. Yeah.
What's the difference?
8
What's the
hours.
difference? 8 hours. So 8 hours idle labor on the minimum side is what you can find within the University of Cape Coast. I mean the cleaning side. 8 hours spare capacity. But they are still
Say
here with us. Yes,
8
please.
hours rather, not
It's
12.
what?
8 hours.
6 hours.
8 hours rather, not 12.
Okay, 8 hours. Yeah. But the point is that there's some spare or idle labor.
Yes, please.
That's the main point we want to establish. So
Okay.
most organizations have these situations. If there is already spare capacity, idle labor time, which means labor is being paid for the job that he has not done. We pay them even though they don't work for the hours they should work. We still pay them. if there is some special contract coming along the way whose labor time requirement is the same as the idle time we are already experiencing, then in costing that special contract in terms of labor cost will be zero. We make the labor who we are paying for doing nothing go and work on the contract. That's effectively what we are saying. So where there is idle labor and the idle labor hours is the same as what a contract requires, then the labor cost to the contract will be zero. Sometimes to the idle time will not meet the full contract labor time requirement. Then the part which will be relevant cost is the excess hours above the idle capacity that is needed for the contract. That one becomes relevant cost. Okay, so this is where we have spare capacity, and you can see full spare capacity and partial spare capacity. I've explained both. How about if you are in full capacity? Everybody is working to maximum. There is no allowance anywhere. And some contract is coming in along the line. How do we cost that contract in terms of labor? This is what will happen. The only way we can accept that contract in terms of labor hours, labor requirement, is to, one, hire additional workers. Because the workers we have, they are all engaged, they are working full capacity. There's no allowance anywhere to give to the special contract. So the only way you can go is to hire or contract additional workers. And you have to understand that if that is a decision, then the cost of these additional workers is coming as a direct consequence of taking the contract. If you don't take the contract, that cost is not borne. And therefore becomes relevant, becomes chargeable to the contract. If we do not choose to hire additional labor, we can also negotiate with existing labor for them to do what they call overtime. Overtime is paid. You cannot make people work overtime and you don't pay them for the overtime. That overtime cost that will arise is arising as a direct consequence of accepting the job or the contract, and therefore chargeable to the contract. So that's it. These are the main issues to note there. So let me give you the summary. The relevant labor cost per hour where full capacity exists is therefore the hourly labor rate plus an opportunity cost consisting of the contribution per hour that is lost by accepting the order. I didn't add that last part. There's also an opportunity cost where there's full capacity. When you choose to make the existing labor work on the contract, it can cause a situation where they will have to stop doing some usual work so they can have attention for the special order. And when they do stop doing some usual work, it is going to cause some loss in revenue. some loss in contribution. The loss in revenue or contribution is indirectly a cost which is caused by a special contract. If you had not accepted a special contract, this loss in revenue or contribution wouldn't have occurred. So that's why it's a relevant cost to accepting the special contract, and therefore any such costs, lost contribution, lost profit, should be charged to the special contract. Any questions? Any questions, please? Any questions? Okay, no questions. Then let's look at this quick example. And I want everybody to be involved in the example. When I ask you a question, then now don't come and ask me, oh, say, can you say the question again? You have logged in and your mind is somewhere else. 9 people in class. Most of who are absent-minded. Lena Atta, are you in class? Lena. Patience Fianco.
Sir, please, I'm in the library, that's why.
Oh, okay. Okay, so now let's look at what I wanted us to take as an example to the labor cost. Suppose that a special job will require 50 hours of labor time. Employees are paid 10 cedis per hour. There is sufficient idle capacity among the workforce for 40 hours of the work. The extra 10 hours will be worked in overtime, for which the additional pay is 12 cedis, 50 pesos per month. Sorry, per hour. What are the relevant costs? Relevant labor costs in relation to this special job. Now, everybody should be able to talk about this. Talk. Please talk. Hannah Bafo. Hannah. Nicole. The names I'm mentioning may not be your official name, but that's how your devices are registered. So if it's not your name, but you know it's your device's name, you have to respond. Nicole Yani. Okay, so let me do my lecture.
Say this, Nikoyani.
Yeah, Nicole Yani, speak.
Yeah. I just
You heard the
joined.
question. You just joined. Okay.
Yeah.
Don't worry. So this is the solution. There is an idle capacity of 50 hours. We are deciding to accept a job which requires a total hours of 40 labor hours. And in principle, the idle capacity or idle labor hour time, if you use it on a contract, we will charge nothing to the contract because it is idle. We're already paying for it. And we have idle capacity of 50 hours. So the whole of the 40 hours, the special job requires only 40 hours. So we can pay the labor, or we can get all the labor hours from the idle time. In which case, no. The special job requires 50 rather. Good.
Yes, sir, 50. And the
50,
idle
and then we
capacity is
have
40.
idle capacity of 40.
Yes, sir,
So
40.
the 40 hours out of the 50 is zero costed in terms of a cost to the job. But the additional 10, it said the additional 10 is actually created by making existing labor work overtime. And when they work overtime, overtime is normally paid at a premium. So even though the normal pay is 10 cedis per hour, once they are working overtime, we are depriving them from having, seeing their families, a lot of social costs. So we have to add something to the normal charge. That's why we are paying them at 12 cedis, 50 pesos. So this is what we use. So the extra 10 hours will be, the cost will be 10 hours times 12 cedis, 50 pesos per hour. And that will give us 100,
125.
125 Ghana cedis. So this is the only relevant cost to this job. And then it was built up as follows. Suppose that another special job will require 20 hours of skilled labor. The skilled workforce is paid 15 cedis per hour and is working at full capacity. Full capacity. If the special job is undertaken, the skilled labor will be taking off other work that earns a contribution of 12 cedis per hour after deducting the costs of the labor and variable overheads of 1.5 per hour. It's just telling you about how the contribution of 12 was calculated. Calculate the relevant cost. Now, this is a full capacity situation. Full capacity situation. Every labor activity on the job will have to pay for it fully. There's no idle thing for the job to take advantage of. So we need 20 hours. All the 20 hours will have to be paid for. And any extra cost will have to be paid for by the contract. These 20 hours times 15. 20 times 15 will be what?
300.
Okay, 300. So that has to be paid for by the special contract. And then it is also saying there's a lost contribution. You lose some contribution because labor needs to focus, direct some focus from existing jobs. A contribution of 12 cedis per hour. So for the whole 20 hours, for the full 20 hours that labor will be worked on, we will lose 12 cedis every hour. 12 times 20 will be what?
240.
12 times 20.
240.
240. Good. That is also a
240.
relevant cost chargeable to the special contract. And then there's going to be some relevant overhead costs, variable overhead costs. This variable overhead cost is assumed to be a variable cost that is incurred from labor activities. So once labor is working, labor automatically generates those costs. So as long as labor is going to work 20 hours, it will generate extra variable overhead cost of 1.5 per hour. That is the contract job as well. So in summary, we can have the cost as this. Labor cost of 20 hours times 15, 300. Variable overhead cost, which is actually being created from labor activities working for 20 hours on a job, will be 20 hours times 1.5, 30. Contribution lost, 20 times 12 hours, 240. So when we sum them, this is the total cost that we need to charge to the special contract as labor costs. And this is in full capacity situation. Okay. So that is about relevant cost of labor. Now let's talk about relevant cost of material. I think for this is not a topic that I can consume in one lecture. So after considering relevant cost of material, we may have to break, and then we will have this lecture recorded as part 1. Then there should be the concluding part, which will be part 2, where we look at some more complete situations like make or buy, further processing, and so on and so forth. Okay, so now let's look at relevant cost of material. The material issue too, let's talk about this. We can have a situation where we do not have materials in stock already. You see, the special contract which we are contemplating accepting or not, it will need some materials to be used. We can have a situation where we have none of the materials that a special contract will require in inventory. We have none in inventory, which means all the materials need to be purchased fresh. That one, it is clear to us that the cost of buying all these material that the contract needs is a direct cost to the contract and chargeable to the contract. We can also have situations where we already have some inventory in stock because we are already a production concern. We have been in existence, we've been producing long before this wayside contract is coming in for our consideration. So from our normal operations, we could have some inventory in our warehouse, which happen to be inventory that we can use for the special contract as well. In such a situation, you need to carefully analyze and know which becomes a relevant cost. One, if the inventory which is already in the warehouse is inventory that we use for our normal operations, it means that when we use them for the special contract, we will have to replace them because we will need them for our normal operations. In such a case, that inventory in warehouse, which we will use for the special contract, the special contract has to pay for it. It's not actually free for him. It's for normal operations. So when you use, we have to replace it. And if we will have to replace it, normally the replacement will be done in some future. And the cost should be at the replacement cost, not current cost, because there could be a difference between the current cost and the replacement cost because of difference in time. It can also be that we have the materials in the warehouse, not because we use them for our normal operations, for which reason they will need replacement if we use them for a special contract. But maybe we overbought them for some past work and they are just lying there idle. In that case, we need to consider a number of things. It is a surplus. We overbought them last period. They are not going to be used for normal operations. But one, can we use them for some other work? Do they have an alternative use? If they do have an alternative use, then deciding to use them for the special contract is depriving us of using them for the alternative use. So there's some element of opportunity cost, which should be charged to the special contract because the special contract is going to deprive us. It's going to cause that opportunity cost. That is where it has alternative use. Apart from having alternative use, or let's say if it doesn't have an alternative use, we have to also consider, does it have a realizable value? Can we sell it? Can we scrap it for some money? Can we sell it? If we can sell it or we can sell them, it means that choosing to use them on a special contract will deprive us from realizing that sales value that we can get from selling them. And that is some form of opportunity cost, which should be charged to the contract because the contract is going to cause that thing to happen. So where there is the case where there is a realizable value, then the loss of the realizable value should be charged as a cost to the special contract, because the special contract is going to cost it. What if it doesn't have opportunity, it doesn't have alternative use, it doesn't have any realizable value? Which will mean that maybe it is almost like a waste in the organization. So if the special contract is going to use it, then the special contract is rather going to help us, dispose of the waste. In that case, there will be no cost to the special contract. But it is most likely not to go to that extreme. Okay, so that's how you have to see everything. So let's see this illustration. Relevant cost of material. When we exhaust this, we will break the lecture here and maybe do a follow-up lecture. George's company has been approached by a customer who would like a special job to be done for them and who is willing to pay 22 Ghana cedis for the job. The job will require the following materials. Material A, B, C, D. And these are other information about the material. Total units required of materials A, B, C, D for the special job. 1,000 material A, 1,000 material B, 1,000 material C, 200 material D. Units already in inventory. 0. There's no inventory. There's no stock on material A in the warehouse. For material B, 600 are in inventory. Material C, 700 in inventory. Material D, the whole 200 that we require is already in inventory. Book value of units in inventory. Book value, let me explain a little bit because you are not accounting student. Book value, when we buy an item, we record the item at the item's cost. Then the item will, through use, incur some loss in value. And we take care of the loss in value with depreciation. So the cost of the item, as we recorded, is a book value minus any depreciation as we move along. Becomes what the books have, the values for the items. So simply put, I don't want to go into accounting technicalities because we don't really need that because of the people I'm recording the lecture for. Book value, in this sense, take it as the value that we have for the items of inventory in the books of account. That's the book value. So book value, because we don't have any of material A in inventory, we don't have any book value on it. Material C, the book value is 2 cedis per unit. Material C, 3 cedis per unit. Material D, 4 cedis per unit. Then this column is realizable value per unit. None for material A, 2.5 for material B, 2.5 for material C, and 6 cedis for material D. Replacement value or replacement cost per unit, 6 for material A, 5 material B, 4 material C, 9 material D. This is the information we have about the material that the contract requires. Further details. A. Material Material B is used regularly by Josh Limited. And if units of B are required for this job, they will need to be replaced to meet other production demand. B. Materials C and D are in inventory as the result of previous overbuying, and they have a restricted use. No other use could be found for material C, which means it doesn't have any alternative use. But the unit of material D has or have alternative use. They could be used in another job as substitute for 300 units of material E. Material E, which currently costs 5 cedis per unit, of which the company has no unit in inventory at the moment. So these are the further information we have about them. What are the relevant costs of material in deciding whether or not to accept the contract? Okay, so we go through the framework that we have discussed already. This material A, we have none in stock. So the whole of the 1,000, that the special job requires, we have to go and buy them fresh. And it's a direct cost chargeable to the special job or contract. This is the purchase cost. In other words, this is the price that currently, if we are to buy, we will buy at 6 cedis. So the cost of material A that should be charged to the special job is 6 times 1,000, 6,000. Material B, we need 1,000 for the job, but we already have 600 in our warehouse. And let's read the footnote. Material B is used regularly by Josh Limited, and if units of B are required for this job, they will need to be replaced. So even though we have 600 of material B in inventory, which the job can use, the job cannot use it for free. When we use, we need to replace. In other words, we will have to get the whole of this 1,000 of material B for the job. So you can divide the calculation as this. We will use this 600, but we'll have to replace it at the replacement cost. So 600 times 5. That should be charged to the contract. The remaining 400 will have to be bought fresh at the same price of 5, which results in the same as 1,000 times 5. Okay. Material C, we need 1,000. We already have 700 in stock. Let's read the footnote. Material C and D are in inventory as the result of previous overbuying, and they have a restricted use. 1, no other use could be found for material C. So material C doesn't have an alternative use, but we can see that it has a realizable value. We can sell it for 2.5 per unit. All right. So if we use this 700, which is there because of previous, we made a mistake to overbuy. If you use this 700 for the job, even though we will not need to replace the 700 and we don't have any alternative use for it, we can sell them. So if you use them, then we are going to be deprived of the sales value of 2.5 times 700, which is some form of indirect cost. Sorry, some form of opportunity cost, which the job is going to bring about and which needs to be charged to the job. So in that sense, the total cost associated with material C for the job will be 700 times 2.5. That is the opportunity cost. That is the realizable value that we will lose because we are using the 700 for the job. And therefore, we need to charge that loss in revenue to the job, 700 times 2.5. Then the remaining 300 will have to be bought fresh. So 300 times the replacement cost or the purchase cost. That's how the analysis will go for material C. For material D, we need 200, and the whole of the 200 is in inventory. When we use it, what happens? Let's read the footnote. We already know that material D was also, we have 200 in inventory as a result of previous overbuying. But that's what the footnote says. But the unit of material D could be used in another job as a substitute for 300 units of material E. It means it has an alternative use. So if we use them for the job, then we are being deprived of this alternative use. This is opportunity cost, which should be charged to the job. And what is the valuation of this opportunity cost? These 200 units can be used as 300 units of material E. Material E costs 5 per unit. So 5 times 300, what is the value? 1,005. So if we use this 200 for the job, we are being deprived of using this 200 as substitute for 300. In other words, we will have to go and buy this material E. We have to go and buy this material E. If we give this 200 to the special job, then the other job which requires 300 units of material E wouldn't have the opportunity to use this 200 units of material D as substitute. We will now then have to go and buy the full 300 units for material E for the job that it is required to do. And that is an opportunity cost. Opportunity cost of 1,500, 300 times 5. 1,500. Yeah. Then this opportunity cost is there, 1,500. We also see that we can sell 200. So now it becomes a comparison between the opportunity cost of 300, which will mean that we have to go and buy opportunity cost of 1,500, 1,500, which means we have to go and buy 300 units of material E at 5 cedis. Now let's look at the realizable value. If we sell and we can get more than 1,500, then it is better to sell and go and buy the 1,500 worth material E so that we can keep the difference. When we multiply 6 by 200, what do we get?
1,002.
1,002. So when we sell and make that gain, we will have to go and buy material E at 300 times 5, which will be 1,005, and that will be a bad business. So we'll decide rather to think of using material D as substitute for material E. And the opportunity costs that we will incur if we use the 200 for the job is that we will have to go and buy 1,500 material E. So that becomes a cost that we should charge to the job, 1,500. Okay, so that's how we analyze all the material. Let's see the solution. I have explained it in words just as I'm speaking, but this is a table to summarize. Material A, 1,000 times 6. Material B, you can split the calculation into 2. 600 times 5 plus 400 times 5, which is the same as 1,000 times 5. That's why you are seeing it here. By breaking it, it communicates the application of the principles. So material B, total cost chargeable to the contract. Material C had no alternative use, but it had a realizable value. 300 times the realizable value. Let's see, material C. Material C, sorry, 700 times the realizable value of 2.5 plus the remaining 300 times the purchase cost. So the calculation was first done on the purchase cost. We'll buy 300 times 4, then plus 700 times the realizable value per unit. So that's the calculation for material C. 300 times 4 plus 700 times 2.5, giving us this total cost to be charged to the contract. Material D, 1,500. That's your opportunity cost. So this will be the total cost, the sum of all of them, which we should charge to the special contract. And then when we match to revenue, assuming we have done this exercise of all relevant costs, then we look at all relevant revenues and whether it will be a good business to do before we say we will do it or we will not do it. Any questions? Any questions? Okay, I guess all of you are cool. So this is where, let's break the lecture here.
Yes.
Doris,
Okay.
you are okay?
Yes, sir.
Yeah. So let's break the lecture here. It's getting long. So that we do a follow-up lecture to conclude it. It's a little bit big topic. I hope that will be cool for you.
Yes, sir.
Okay.
Yes, sir.
So if you don't have any lecture, then this is where we bring the whole lecture to a close. Thank you very much for your attention.
Thank you, sir.